Hey everyone, Mayhem and Ayesha here from TradeOutLoud. We're here to do a presentation about macro investing using pair trade strategies for sort of longer term swing trades. So just wanted to dive in first to the local macro situation here. In the United States, we have an aggressive Federal Reserve. They hiked 75 bips in June and another 75 bips in July are likely, at least priced in with, I think, about 60-70% certainty at Fed funds futures at present. And when CPI printed, last week on Wednesday, it was 9.1%, which was, I think, the highest in 4 decades. Initially off that print, we did see that Fed funds futures were pricing a near certain 100 bips hike, but Fed speakers did walk that back just a little bit. We have a weakening economic backdrop in the United States. In fact, the Atlanta Fed GDP Now model is showing a projected contraction of 1.6% for Q2. If we do have that, it would constitute a technical recession of 2 sequential quarters of contraction. We have a struggling consumer. Spending is dropping in real and now nominal terms for what we're seeing from some of the bank major earnings, as well as some of the econometrics that have come out. So that just gives us a little bit of pause because the economy is driven by two-thirds of the economy is driven by consumption. So when they're starting to pull back and consumer sentiment is at historic lows, it's certainly something to look at. Moving forward, we also see that housing and auto markets are both slowing. Housing's about 15 to 18% of GDP. Autos are about 4%. So it's a big chunk as well. We also have the lowest mortgage origination in 2 decades and home sales slowing, as confirmed by some of the data we got this morning. We have rising rates putting further pressure on consumers, businesses, state governments, and federal deficit spending on interest, which is going to be a concern as we move forward. Fed policy is also tightening with a near certain recession that could amplify long-term supply chain constraints. So this is just the overview. We're going to get into some charts now to just show this data in more detail. First is Fed funds futures and the implied probabilities of a terminal rate of 3.5 to 3.75%. And that looks like that's something that would hit later this year through mid next year. And then the first cuts possibly coming as soon as the summer. So that's something to just keep an eye on. These probabilities are changing as we get different econometrics. And of course, the Fed meeting in a week from today should give us some more clarity as to what their plans are. We also see with the CPI print we had last week, that 9.1% year-over-year print was driven by things like energy and services inflation being some of the larger drivers there. Certainly something we want to keep an eye on. We did see energy prices, both in terms of gasoline and oil, come down a bit. Natural gas has leveled off a little bit as well. So some of that pressure may be alleviated in terms of the velocity of inflation, but the stickiness of some of these prices in other areas are likely to persist a further headwind for consumers. Atlanta Fed GDP Now, this negative 1.6% print for Q2. As we get more econometrics coming in, this is just continuing to make it a little bit more certain that it does look like we're probably going to have a recession. And one of the reasons for that is that as we get more econometric data in, this forecast becomes more and more accurate. So the more backward-looking data for basically at this point, June, that we get in, it more seems to confirm the idea that we'll probably see something of a slowdown moving forward. Home sales are also continuing to drop, actually down 14.2% year over year. I think that is a bit disconcerting. I know we had a big spike in home buying last year, and there was a limited amount of supply, and there were a lot of people very excited to buy new homes, but it does seem like the housing market is prone for further weakness. And finally, or second to last year, automotive sales volume in 2022 is lagging what we saw in 2021. So that's just showing that other big part of our economy is starting to lag too. Consumers are being priced out. Lenders are being more careful as well. And on the home sale side, as well as the auto sale side, rising rates are compressing demand. We also see rates are rising across the board. And, whether you're looking at the 10-year treasury, the 30-year mortgage, Fed funds, 30-year bond rates, or the 2-year, everything has had an enormous rise this year. This is also the other side of the bond market being pretty much the worst start to a year in 40 years. And international bond markets, the worst start to a year ever. Zooming out to international macro, we can see that China may be starting a new credit cycle driven by fiscal and monetary stimulus. Their economy has been really weak. The lockdowns have been a big problem. And it does seem like the central bank and the government are becoming a little bit more eager to try to ameliorate some of that slowdown. They had a target of over 5% GDP growth this year. It seems highly unlikely that's going to happen. But I think that will compel both the central bank and the government to engage in more aggressive stimulus. Japan is trying to keep their credit cycle afloat, but they're struggling with weakness in their currency, which has been evidenced by the yen being down about 18% year to date, also increasing volatility in their bond markets. And as import prices rise, it's creating some inflationary pressure, and their economy is already quite vulnerable. It's struggled to grow really for the last 30 years after the real estate crisis. So, China looks like it may be a little bit better off here. Japan looks like it's deteriorating, and so does Europe as it continues to struggle with both slowing regional economies and rising inflation. In fact, the ECB has indicated that it will be more hawkish about policy, but it's also talking about trying to control yields on the longer end of the yield curve for struggling sovereigns, which is kind of an interesting paradox in some ways. When we look at international, Ayesha and I have a macro pair trade idea that we came up with here. Part of it comes back to an article we did, a deep dive on China in our TradeOutLoud blog recently, and we have some reason to believe that it may be early on in their bull market that might be starting as a part of this new credit cycle. So long China and then short Japan for the reasons mentioned above from a macro perspective. And when we dive into the technicals, we can see that relative strength in China is actually pretty good versus Japan here. If we look at, from March to the present, we see some consolidation of late, but I'm still remaining optimistic about this trade. I still think that Japan has some very serious structural issues that are going to continue to plague the country's both stocks and foreign exchange rate. And EWJ does give you some exposure to the Nikkei priced in yen, which is one reason that I think this also makes this trade a little bit more interesting. When we dive down to the technicals on FXI, which is the large caps of China, we can see it actually looks pretty constructive so far. We're looking at this chart from a couple of different vantage points. If we look at the volume profile, we're starting to grind into a pretty big area of supply. So where we are now is key, that we can hold above this level and continue to trudge higher. We're above the 8-day moving average. We're above the Ishimoku cloud. So we are in a longer term and shorter term uptrend. So I like the technicals on this chart. I think it has more room to run, but if it slips below the 8-day moving average, and or the Ichimoku cloud, I would be more concerned about the health of this trade. Japan is starting to look like it wants to put in a little bit of a bottom here, but it does remain below the cloud. It does remain below some significant areas of supply. And the BOJ has continued to say they're going to support their bond market, which likely means there's further pressure on the yen that may offset gains in their indices. So I still remain cautious of Japan and bearish of it and favoring that short side of it. And that's one of the reasons that Ayesha and I both did a lot of research on both sides of this, and we both feel that China is in a better position, Japan's in a more vulnerable position, so the pair trade may be an interesting opportunity to watch. Now, if Japan's EWJ broke above the cloud here to the top of this red area, I would be much more concerned in taking off short positions in that trade. And then there's the local macro pair trade idea. Ayesha, you want to take the lead on this one, and I can shift slides as appropriate?
Yes, sure. So our local macro pair trade idea was healthcare versus retail. And this is basically because we are seeing that we are in late cycle to imminent recession, as Mayhem just pointed out. So when we're entering this phase of the macro cycle, we usually see healthcare do very well, and we see retail suffer. So if you could just move to the next slide, please. Right. So our macro thesis is based on the disposable personal income. Okay, so we can see what's happening. So during the last 2 years, we know what happened. There were stimulus checks, and obviously people's income, just soared. And you can see that in these two spikes over here. These spikes actually represent the times when the stimulus packages went out to people. And now what's happening is so this is real disposable income. So it is adjusted for inflation. So what we're seeing now is not just people, like the stimulus money drying up, but as well at the same time, we're seeing people get hit by inflation. So whatever they had in purchasing power is obviously coming down even more, which is yet another reason why healthcare should do well and retail should not. Healthcare is a basic need, obviously. And so as we're coming out of the COVID cycle, I think we have two basic issues over here. Is put off a lot of, let's say, discretionary healthcare needs. They put off, going to the dentist. They put off, surgeries that they didn't immediately need, all because, there was a scare of going to the hospitals. And what we're seeing in the data now is people actually going back to hospitals for doing, their um, surgeries, minor surgeries, elective surgeries. So you will see a trend where, healthcare spending starts to go up, and for the basic needs as well as the elective needs. So, and as we come out of, the late cycle, what we tend to see in the recessionary period is that because of the dividends that healthcare companies do issue, they stand a better chance in terms of cash flows and doing better in a recessionary period. So basically, stocks don't do very well in a recession, but healthcare is still something that does relatively well, let's say, in a recession. Okay, so can we go to the next slide, please? I can't see to move it. Yeah, okay, thank you. So when we look at retailers, what we're seeing is, obviously, I mean, you must have seen the earnings from last quarter where, everybody got hit with a huge amount of inventory. So the inventory cycle, the inventory to sales ratio is a very important cycle, and we see it increase every time, we see a recession coming. So there's no doubt that we know that a recession is coming. And what we're seeing is it's inching up. Now, while it's still much lower than what it was before, we still think that this is, this shows that retailers have a supply glut. Not to mention the price of inputs are going up because of supply chain issues. So what we have is so if you remember over the last 2 months, what we saw was the price of cotton soaring, for example. However, this hasn't worked itself into the system as yet because manufacturing typically takes anywhere between 6 to 9 months. And so you will gradually see stuff like, clothing and footwear and all of these start to increase in price gradually. I mean, you may have already seen it in the stores, but trust me, it's going up even more. And therefore, these become discretionary items, right? So you're not going to buy a new shirt if you don't have to. And with more and more people wanting to work from home or wanting to work in a hybrid model, I think people will stop spending as much on discretionary items. So if we can look at just the next slide, please. Now, why I still think that there's room for for retail to drop is because if you look at these, this shows you the PCE numbers, basically how we've increased from 2020 to 2022. And if you see, we're still so for durable goods and for non-durable goods, we're still very much higher than where we were in the first quarter of 2020. And that's like the pre-pandemic time, right? So we still have a lot of room to run to the downside, let's say, when it comes to spending on durable and non-durable goods. So I think we still have room for for retailers to drop further and for prices to come further down. The next slide, please. Okay, so Mayhem, do you want to take this, the relative strength? Hello.
I'm so sorry. I had my mic muted, so no noise bled in. I'm happy to take it from here. So what we're seeing on a relative strength basis is healthcare is consolidating, but it is still in a decisive uptrend versus retail. As Ayesha spoke to, healthcare is necessary, retail is not. And I think this chart shows that to us on a relative strength basis. Healthcare has been outperforming retail by a lot this year. And, you see that there's also a stronger bid just from a factor perspective for low volatility stocks. Those low volatility stocks tend to be the more defensive stocks, utilities, healthcare, staples. And there's a lot of folks getting out of these cyclicals, and retail is a component of that. So I think we see that in this chart in the price action. And healthcare, in this case, it does not include biotech. We are really just talking about the providers of healthcare services, not the speculative components in the medical industry. XLV is consolidating. So when we look at the healthcare ETF by itself on a weekly chart, we can see it's consolidating some of the gains it's had. It still appears to be healthy. It's over the 8-week moving average. It is within the cloud, which means that it is technically trendless. And the Williams oscillator is showing us that it's in that state of consolidation. So we do want to watch it. You can see this large shelf of supply overhead. We're going to want to see it break above that. On a break above that, I would be wanting to put the long leg of this trade on, because what that's telling me is we're above this area of transactional activity where sellers have been consistently taking control where they had the opportunity. So above there, I feel like we could start to really run higher. And that would also bring us above the cloud and confirm a weekly uptrend. The picture in retail, not so good. The ETF seems to be on sale, and yet it's not cheap. We see it rolling over from really December of 2021. This was around the time where consumer participation in the economy really started to peak, and we started to see that expressed in spending trends, especially on real terms as inflation picked up. People were still spending more money, but they were getting the same or less. And so that also shifts demand, and we're seeing, more people buying staples versus discretionary. And so retailers aren't making as much money, and we're seeing that in this chart. It's something to keep a close eye on, because even though it has broke above the 8-week moving average, the momentum is decisively negative. It's well below the weekly cloud. So we are very much in a downtrend. We may be putting in a lower high here. So we want to see if there's continuation. But on a break below the 8-week, I would be looking to put the short leg on of this trade and only be taking that off either when we revisit, and I know it sounds a little drastic, but probably about the $40 range where that big area of demand is, or if we break above that 8-week moving average on a weekly closing basis. That might give me some cause to say, okay, well, this trade's not working out the way I had hoped. The next trade idea that Ayesha and I have is a commodities macro pair trade idea. And Ayesha, did you want to talk about what's going on in the oil market here?
Sure. So what we're seeing what we've been seeing over the last 6 months to 8 months in the oil market isn't normal. The way oil has been moving, the price of oil, the way it's been moving, it's been extremely volatile. Okay, but we still think that there's more room to run to the upside, and here's why. We're still extremely under capacity where oil is concerned. I mean, there's oil in the ground, but there's not enough refining capacity at all. And I think we all know this. We know what's going on in the US. We know what's going on with the policies and how they're, most of the oil companies are not being allowed to pump enough oil. But this is also a global phenomenon. So if you look at the amount of investments that have gone into oil, even in the Middle East or any of the OPEC countries, and the Middle East is like the leader. So if you're looking at Saudi or UAE, where I'm from, even we have cut back on investments in the oil sector. And this is our bread and butter. So it just tells you that while people are trying to move to renewables and other sources of energy, they have been significantly cutting back on oil. However, having said that, I don't think renewables are anywhere close to providing us with the energy source that we need. And therefore, we're in a situation right now where we don't have enough investments, or we haven't been investing enough in oil, but we still need it. We're still well below pre-pandemic levels if you're looking at demand right now. So what my estimate for next year was about 100 million barrels per day, but now we're hearing that it could be much more than that. What we're seeing in the price of oil right now coming down below 100 is more or less, I think this is short-lived. I think we have further to go where, the price of WTI is concerned. In fact, Jeff Curry of Goldman Sachs says Brent should be somewhere around $130 per barrel. And so if you take the differential between that and WTI, we should be somewhere around $120 to $125 per barrel on WTI. And I think this is pretty feasible. In fact, I think it could even go higher, because China is closed right now. So there's a lot of inactivity in the market. And when China comes back online, I do really think that there's going to be a major, demand for oil, and it is going to move the price of oil much higher because we also have supply constraints on the other side. So what we're seeing in terms of Russia is not that they're not being able to sell the oil. I know for a fact that they are being able to sell the oil, but what's happening is people are hoarding those supplies because so people like India, people like China, they're hoarding the supplies. So you would think that that would probably help with the price of oil coming down, but it doesn't, because what they're doing is they're artificially keeping the price of oil higher, or they would be keeping the price of oil higher just so that they have supplies for the longer term. Because I think it's not just me saying that we don't have enough oil in the world, but I think it's everybody seeing this. And what we saw over the last 2 years, like, the reduction in the demand for oil actually helped the world a lot in terms of shoring up oil capacity and shoring up enough barrels of oil to store. So this is going to play out over the next few months, I think over the next 6 to 9 months. But where we see the pair trade doing well in terms of oil are the oil companies. So even if the price of oil fluctuates, comes down to 95, 99, whatever you say, unless it drops significantly below $70 to $75 a barrel, I think the oil companies will still continue to do well. So we had Halliburton kick off earnings yesterday, and if you looked at how they performed, I mean, they've done so well. And I think this is a phenomenon you're going to see going forward, at least for the next 2 quarters. And if you need further proof that oil companies are going to do well, just look at how Warren Buffett is buying Occidental. I mean, the man knows something for sure. And I think this is why, I mean, not just because he's buying Occidental, but I think, he's got it right. Oil companies will continue to perform. And as long as the price of oil remains anywhere around $75 a barrel or above. Mayhem, do you want to talk about gold a little bit?
Absolutely, yeah, and I love all the thoughts you shared on oil there. That's a great segue to what we're seeing in gold, which is kind of the antithesis. I mean, everything is setting up to be a painful experience for people that are bullish of gold, because not only from a technical basis has there been significant structural deterioration, but with the velocity and the rate of change of interest rates, especially breaking into real rates that are in positive territory, combined with a strengthening dollar, combined with crypto acting as a conduit that's sort of a speculative relief valve for excess liquidity, in particular being advertised as an inflation hedge. Whether or not that's true, I think we're starting to see it's probably not, but nevertheless, it does take demand away from gold. And the other part of it is that, the safe haven component from the Russia-Ukraine war that led us to almost retesting those all-time highs, that seems to be completely faded. It seems like geopolitical risk, whether real or imagined, is not really being priced into the gold market. I think that's a concern, if you're bullish of gold. And then the other thing we're seeing is that there's significant technical deterioration in silver and the miners for both metals. And what you really want to see if you're going to have a structural gold bull market or even a cyclical gold bull market is silver, gold, and silver miners leading the charge, with the precious metal itself kind of following along. And we're just not seeing that kind of price action. So to me, that's also telling you there's a vote of no confidence from institutional allocators. And we know the gold space and the mining space is a pretty well hated space, but it also tends to do really poor in environments where the velocity of inflation is high, but rates are also ratcheting higher, very rapidly. So I think that's part of the concern. I think that's one reason gold doesn't have a strong bid here. Looking at it from a relative strength basis, I'm just going to get to the charts here. We can see that oil seems to be much stronger than gold on relative strength from a weekly perspective. And you can just see this chart shows us a series of higher highs and higher lows up to the present, where it appears as though we may be putting in yet another higher low. So we can see that oil, which is, a commodity that has a lot of usage, the world economy can't live without it. The United States is pretty much 80% driven by hydrocarbons, and a good chunk of that is oil. And yet gold, while it has a monetary value, it's just not really needed. It's more sought after. So I think that that's one of the things that's happening in this trade is that, you've got folks that absolutely need oil, and you've got folks that are willing to sell gold, for example, to buy it if they need it. But you also have gold in just a very disfavorable macro environment for the reasons that I mentioned, and oil in a very favorable macro environment for the reasons that Ayesha mentioned. So for this pair trade, we're looking at it from a macro perspective. We're looking at it from that fundamental perspective that Ayesha mentioned, and we're also looking at it from this technical perspective. And when we see this kind of coalescence, and I just want to kind of do a 30,000 foot view here on all these pair trades, it gives us more confidence because that coalescence is telling us that there are multiple areas that validate the thesis that can also be checked back later to ensure the thesis is still intact. Relative strength being one of those key areas for all three of these trades. And oil appears to be technically rebounding. It actually found its legs. It never broke below 90. We are below the 8-week moving average. The Williams oscillator is showing negative momentum, but we are above the cloud and we are above some pretty key areas of demand. So for me, I'd like to see oil stay above 95 and continue to run higher from a technical basis, eventually taking out that 8-week moving average to the upside. That would get me into the long leg of this trade here and make me more confident. And similarly, I would be exiting this trade if it breaks below that 8-week moving average, just from a momentum perspective. I also think that XLE is a very interesting component to watch for this trade. As Ayesha mentioned, the energy stocks, many of these companies are still able to produce oil with a strong profit, as she mentioned. So even if prices decline more, XLE could be more resilient. And if we recall back to some of the corrections we've had in oil, you've seen that XLE actually kind of didn't respond the same way the commodity did. So if we go back to November when oil had days where it was down 7-8%, XLE was weathering the storm down 1-3% and was more buoyant on its recovery, eventually dragging oil higher with it. So I think that's another thing to take into consideration, which is Ayesha's point that energy stocks could have a stronger bid than oil itself. If oil's flat, these stocks are still immensely profitable, and Buffett's bid speaks to that. Gold seems to be topping out. This is a very dangerous looking chart to me. We saw gold break below 1,700 yesterday, or at least over the last week, right? We saw basically get to 1,695. It's below the cloud. It's below the 8-week moving average. Momentum is decisively extremely weak. There's a huge amount of supply overhead from previous transactional activity, and this looks like a double top. So to me, I'm very concerned about gold. I don't see any reason why this thing can't head back down to around 1,550 or so, where we start to see some demand zones really perk up again. But for now, caution is warranted on gold, and I would actually be more than willing to put the short leg of the gold trade on as we are here, looking to exit it if we do break above the 8-week moving average on a closing basis. And just as Ayesha mentioned, XLE is a potential long, GDX, and especially GDXJ, or the junior miners that are more vulnerable, could be an interesting short leg of this same pair trade strategy. So that is the presentation as we have it. Ayesha, did you have any closing thoughts you wanted to share?
No, I'm fine. Just exactly what you mentioned, that XLE could be a good trade over here, because not only are the companies doing well, but at the same time, if you see how they move, the volatility is much lower in XLE versus WTI. There's always a little bit of a lag. So for anyone looking to do a trade, which is slightly more conservative, I think XLE could be a nice substitute to WTI, and the same for GDX versus gold itself.
All right, so it sounds like we're ready to panel any questions that people may have. David, are you there?
Yeah, I'm here. Okay, so yeah, everyone in the room, if you have any questions, go ahead and type them in the chat.
We have someone raising their hand.
See, I'm not seeing any questions yet. Do you
But
do you have
was there
any?
someone raising their hand though as a participant in the meeting?
I'm not sure why they are. You guys talked about gold and oil a lot. Do you have any thoughts about, unless I missed this, silver or copper or any of the other commodities?
Sure. I think the industrial metals are actually a bit vulnerable here. I would love to hear Ayesha's thoughts as well, but from what I've seen with copper, and it's often referred to as Dr. Copper, as it's sort of a barometer of economic health or heuristic for global economic health. The destruction in both the technicals and demand for copper itself has been rather profound, down over 30% from its highs. I think it touched just over 5. And now it's trading at 333 on the front month contract. So from a technical basis, copper looks really bad. I know we have structural deficit issues, so I imagine when demand starts to come back, copper could be a more buoyant there. Do you have thoughts on copper, Ayesha?
No, I mean, similar to yours. I think, copper is, crashed pretty much from where it was. Could go a little further down, but I don't think it's going much further down because, we're already seeing signs of a recession. That's it. I mean, I don't think it's going too much further down.
And then, David, you asked about silver. Oh.
Okay, so we have some questions
David,
here.
you had asked
do you want to should we read out the questions? So one of them is XLV a buy or a hold? I would say XLV is a buy. And simply because of all the reasons, of course, we mentioned, but XLV got beaten down quite a little bit during the mid-cycle and during the COVID period. So I do think there is still room to the upside. So I would still be buying XLV over here. I mean, I am buying into surgical instruments. I like Danaher. I like UNH. So yeah, I'd say XLV is still a buy here. Do you, Mayhem, do you have anything to add?
I agree. I think defenses continue to be in play as we're in an end cycle environment. So, XLV and even things like XLP and XLU could be attractive as long sides of pair trades versus cyclicals or mid to late cycle plays such as retail or industrials. So I think we do have, and Ayesha had that idea of potentially industrials as a short leg of this trade as well. So I think we have, kind of a theme here: long end cycle, short as a potential pair trade as we head towards this recessionary environment, as the Fed essentially induces a recession to try to destroy demand. And one thing I did want to touch on just really quickly, and then we can get to some of these other questions, is this is an interesting macro environment in the United States for one other reason, and that's that the Fed is raising rates into a weakening economy during a time where consumers are really struggling, but also during a time where supply chains are really struggling. And one of the reasons that this might be a bit of a concern is we've seen energy companies, base metal miners, and others really not invest enough in exploration or production. And we've also seen similar with transportation, where there's not a lot of elasticity there. And that, is evidenced by both trucking and shipping, where rates remain high, although they've come down a bit, as well as delays remain high. And so I think that one of the issues is when we're seeing the Fed tighten rates into a slowing economy, and with a high cost of labor and companies facing lower business demand and activity in general, that could create a situation where we don't see these supply chain issues resolved. And so they could come back to haunt us in the next new cycle that we see, when the Fed finally pivots and starts to cut rates. Assuming that these issues aren't resolved, we could start to see them come back a little earlier. And that would mean inflation coming back a little earlier, which could portend to shorter, more shallow credit cycles. And this is something that Ayesha and I have talked about a little bit, but BlackRock also released a note about this not too long ago, speaking to similar. And one of the things is, if you put yourself in the seat of a CEO of one of these companies, they're already under pressure from investors to be efficient with CapEx. They're already under regulatory scrutiny where the cost of doing any kind of exploration or production is higher than it used to be. And they have, the concerns of, hey, our labor costs are going up, business activity is going down. Are they really going to invest more during a time where there's a lot of economic uncertainty? The answer to that question is probably no. So some of these issues that seem to be cyclical in nature initially are seeming to become structurally embedded insofar as the supply chain deficiency of elasticity. And I think that is going to be a problem that could haunt us for the next credit cycle or two. And if we go back to the 1970s, 80s period, it did take two recessions in the 1980s to finally squash inflation. And I'm not saying that past is prologue, but we do seem to at least be setting up for an environment with shorter credit cycles and perhaps as a result, less buoyant bull markets. So that's something that, we're watching as we move forward as a part of all this. And in terms of views on the Forex market, I think the dollar has an incredible run. It got to levels we haven't seen in multiple decades. And, it's definitely something to keep an eye on. One of the Forex trades that I had put on recently and Ayesha had put on recently as well, and we've taken it off since, but it was a decent trade, and it still may be a decent setup, which, short the Swiss franc, long the dollar. But I'm at this point, I'm kind of not really in the position to make any long-term Forex calls because there's so many moving parts here, and it has a lot to do with two things. A lot of the time, pair trades, what happens between them, there's obviously supply and demand flows, but a really big driver has been the macro picture, and that's juxtaposed between the economic strength and weakness between these, two opposing currencies, as well as policy, differential interest rates. So we saw yesterday the ECB said, hey, we're going to be slightly more hawkish than we had prognosticated initially, and the dollar came down quite a bit. So I think we really want to pause and wait and see if the momentum in the dollar rally is over and it begins to reverse and stall out. If that's the case, there could be a lot of opportunities going along other currencies versus the dollar, but we're not quite there yet. Ayesha, did you want to add some thoughts on the Forex front?
No, I similar to yours, but I do think that the dollar remains strong here. We have rebounded a little, but I still think the dollar will remain stronger than most of the other currencies. I think the JPY will continue to weaken against the dollar. I think we might see a bounce back in the euro ever so slightly as and when the ECB starts to raise rates. We might see a slight bounce back in the GBP as well. Again, because the UK is as well raising rates. But I still think the Fed is a lot more aggressive, and every time they go ahead and raise rates, I think we're going to see a slightly stronger dollar over the next maybe couple of months. But having said that, I think you should heed Mayhem's warning in the sense that it's still pretty volatile out there. So if you are taking trades, I would suggest smaller trades, stop losses, and watching the market very closely.
And one thing I wanted to add on for both of us is everything that we're sharing here are just ideas. There's no trading or investment advice of any kind. Anytime you might put on a position long, short, or somehow manage through derivatives like options, there is the risk of losing your capital. In some situations where there's leverage involved, you may lose more capital than is in your account. So please discuss any of these ideas with a financial advisor to be sure they're appropriate for you. Does anyone else have any questions or feedback for us here?
I think there was one more. Which XLE and GDX positions would you recommend? Do you mean in terms of stocks?
Yeah, Bullet, did you want to clarify that for us?
Yeah, that's what I was taking it to mean is which stocks in those markets do you like the most?
Sure. Well, Ayesha, I don't know if you had ideas there. I mean, for me, in XLE, I like Devon Energy quite a bit. I know that's one that you like as well, symbol DVN. In terms of GDX on the short side, personally, I actually just favor shorting GDXJ because it's a bunch of junior miners. Their funding costs are higher. They're less certain in terms of their business prospects. So I would personally favor shorting the GDXJ ETF rather than going into individual stocks where there's more tail risk either way.
Yes, and so in terms of gold miners, I would say the stronger ones are Barrick Gold and Franco-Nevada. They're bigger and they're stronger, as well as Newmont. So probably stay away from them if we're looking at shorts. And in terms of oil companies, I do like Devon a lot. I also like Chevron. I like yeah, I think Chevron and Devon would be two of them. PXD as well. Yes, PXD as well.
And
yeah,
I see.
this is TLT
Oh,
a
sorry,
sell?
go ahead, Ayesha. Yeah.
No, so Mike has another question. Is TLT a sell? This is probably for you, man.
I can give the technical perspective and a little bit of the macro perspective here. And Ayesha, I'd love to hear your thoughts as well. But basically, if we are indeed going into a recession, it is likely that we'll start to see a bid on the longer end of the yield curve. That would mean that TLT would start to get a bid. Right now, we're in a technical pattern I'd call a pennant. So there's not really a lot of decisiveness right now, but it is kind of coiling up for a larger move. My thought would be this: there's no reason to rush into anything. Let's see what the Fed does next week. Wait 2 days after the meeting to see how things settle out. We'll get a better idea potentially of QT, of their near-term rate policy projections. We'll also see how the market reacts to that. We also have some more auctions coming up that'll give us a sense as to demand for the longer end of the yield curve. So I'm not in a rush here. TLT, from a technical basis, needs to kind of tell us what it wants to do. If you believe in the inflation side of the trade, the trade is to probably short TLT. But if you believe in the recession side of the trade is probably to long TLT. But I'm waiting for it to break out of this pennant before I make a trade in either direction. Ayesha, did you want to add some thoughts to that just on the long bonds?
No, absolutely. I think, the way to look at it is technical now, because if you're looking at it from a macro perspective, first of all, TLT is a really weird rate because it's a 20-year rate, which is, neither here nor there. Not a lot of, rates are keyed off of the 20-year rate. It's either 30 or 10 or 5. So it's a difficult one. But at the same time, we're seeing the yield curve invert. Oh, sorry. So the TLT is 20 and 30. Okay, fine. Thank you. But we're seeing the yield curve invert, and it's been inverted for a while now. I mean, this is probably one of the longer inversions that we've had in a long time. But it's flip-flopping a lot. And I wouldn't really take a call right now on bonds, because bonds are not exactly behaving the way we would expect them to always behave. And I think Mayhem is absolutely right. We're in a situation where we're seeing quantitative tightening, something that we've never really seen, or we've never really seen the full effects of it. So I just be cautious here. I wouldn't be taking any bond positions right at the moment either. I mean, I don't have any bond positions right now. I sold everything. So from personal experience, I'm not taking any positions at the moment.
Great points, Ayesha. All right, those are all the questions that we see in the chat. If anyone else has any questions, we're happy to answer them. Looks like we've just got a couple minutes left, so feel free to ask any questions you guys might have. And we really appreciate everyone tuning into this, whether it's live or recorded. And both Ayesha and I, just so you guys know, we are over here as co-founders of TradeOutLoud.com. And so you guys, they're retail. If you're interested in trading, investing, multiple time horizons, learning micro to macro market analysis, whether it's fundamentals, obviously macro and technicals, we cover that all both on our website and our Discord.
Yep. And we're on Twitter as well, so feel free to drop by and follow us. We try to share helpful information as much as possible. If you still have any other questions, please feel free to just look us up on Twitter.